The second module is what the banks don't tell you. We all think, hey, let me go to the Bank of America, Chase, Citibank, because they're well branded, because there's one on every corner. But there's also mortgage bankers and mortgage brokers. And there's a lot of nuances that the banks don't want to do and don't offer, making it better for you guys to use mortgage bankers or mortgage brokers. So in this module, we're going to talk about a lot of the things that the banks don't tell you. Okay, we're moving right along here. What the banks don't tell you. First of all, the big banks, we know who they are. They have a bank on every corner. They don't really love doing mortgage loans. They love doing checking account, savings account. They actually like doing commercial loans. Why? Because they can make a bigger spread on their money. We're going to talk about Fannie Mae, Freddie Mac, and FHA in the future slides, but they don't love to write that paper. And as a result of that, the underwriters at the big banks actually have to underwrite a certain amount of loans every single day. They don't have to underwrite and approve a certain amount of loans. They just have to get through. So if there's something on there that's a little different, the big banks really just try to move you along and they either approve or deny. I say all the time, as mortgage bankers and mortgage brokers, the big banks make us look good every single day. The mortgage bankers and the mortgage brokers only get paid when loans close, so they're going to inform you and work with you because they're on the same side of the table. There's much more about the big banks that we'll talk about in the future slides. Who is Fannie Mae, Freddie Mac, and FHA? They are actually all owned by the government now. And in 2007 and 2008, Fannie and Freddie were failing because of the mortgage crisis, and they were quasi-government agencies backed by the government, but they were not owned by the government. They are now owned by the government, okay? And Fannie and Freddie, when you put less than 20% down on a mortgage, use outside companies to insure that loan. In the next two slides, I'll explain what that means. Fannie Mae and Freddie Mac, also known as conventional loans. As I mentioned, they are now fully owned by the government because of the 2008 crisis. They are the main regulatory agency for conventional loans in America. Whether you're a local bank, whether you're a big bank, whether you're a mortgage broker, mortgage banker, we all use either Fannie or Freddie or FHA to underwrite and close your loans because it's the buying and selling of those loans in the bond market that backs the American collateral, which is housing. Okay, now, they also have special products, such as Home Possible and Home Ready, which are products that give a little better interest rate, a little more flexibility for the first-time home buyer. Now, they're really trying to compete with FHA, which was more of a first-time home buyer product, which I'll explain in a minute, but the Home Possible and Home Ready, they have income limits, but if you fall within that, you can get a little better deal on the interest rates. 99% of the time, the lenders sell to either Fannie, Freddie, or FHA. There's this thing called Fannie Mae DU. It stands for Desktop Underwriter. Freddie Mac has this thing called LP, which is Loan Prospector. When we take a loan, we put it in the software, we pull your credit, we put your income in, we put your assets in. The DU or the LP reads the criteria, understands who you are as a borrower, reads your credit score, and makes a decision. And if it comes back approved eligible, we underwrite to exactly what it asked us to give. Now, a lot of times, if you're a W-2 employee, you'll get a no tax return approval. If you're self-employed, that doesn't happen as much because with self-employed, which we'll talk about later, a lot of times people have gross revenue, but their net revenue is a lot lower. But with W-2, we oftentimes get a no tax return deal. So when the system tells us what to do, we underwrite to that. And most of the time we know, the lender knows exactly what to get from the borrower, but we're going by the Fannie Mae, Freddie Mac system. When you hear about mortgage-backed securities, here's a high-level lesson really quick. Mortgage-backed securities are the buying and selling of the mortgage bonds in America. It's Fannie, Freddie, FHA paper. So what happens is Wall Street will trade that paper right back by the house, and it might be a 6 1/4, 30-year fixed note, and then bond traders will trade that note back and forth. All you need to know, back to 1937, believe it or not, when FDR passed a new deal that if you take a 30-year fixed mortgage at whatever percentage rate, it's fixed for 30 years, even if that loan gets sold or traded, your rate never changes, the terms and conditions of your deal never change, but that loan can be sold to another servicer, so you're good. But that's what mortgage-backed securities are, is the buying and selling of the bonds on the Fannie Freddie FHA paper. FHA/Ginnie Mae, which is the same thing. But before I do that, I forgot one thing with Fannie Freddie. Fannie Freddie conventional loans, they do not insure loans. Whenever you put less than 20% down, you have to get mortgage insurance. With conventional loans, there's outside companies that insure that loan, which is companies like MGIC, RHMI, they insure the loan. What is mortgage insurance? Many people don't even know that. Mortgage insurance, believe it or not, is in case you default, the mortgage insurance company is on the hook for the foreclosure and the cost of the foreclosure. So it's not what you think. It's not insuring your house. It's actually a policy you have to pay for that protects the lender. With conventional loans, it's covered by outside companies. Now let's transition to FHA Ginnie. They actually insure loans. They don't make loans. What that means is, with FHA loans, because they allow for a lower credit score, a low down payment, and sometimes seen as riskier loans, the government created a program, which is also, everybody thinks it's a first-time homebuyer loan. It is, and it could be, but you could actually get 10 FHA loans in your life. You just can't have more than one at a time. There's this 100-mile rule where you could actually get a second one if you move more than 100 miles away, but just remember, it's one at a time, 99% of the time. Now, with FHA, it's a little different. There's an upfront, what they call mortgage insurance premium fee, right? With conventional, it's called mortgage insurance. With FHA, it's called mortgage insurance premium. There's an upfront fee. It's usually about 1.75%. It's changed a little bit over the years, depending on a few criteria. Good news is it's rolled into the loan. You don't have to write a check for it. So it could be $5,000 or $6,000. It's actually rolled into the loan, which is good. But the double whammy with FHA is that you also have monthly mortgage insurance at 0.85%. So it's, a little less than 1% on a $300,000 loan. It ends up being $280 or $270 that you have to pay monthly. Now, there's all sorts of rules with FHA on how long you have to keep it, but keep in mind, if you get an FHA loan and you're in that loan for a couple of years, at some point you're going to have enough equity to refinance into a conventional loan and get rid of the mortgage insurance. Also, the natural level of amortization on the loan and the natural level of appreciation gives you equity in your home. FHA rates are typically about a quarter point better than conventional, but the FHA mortgage insurance is a little more expensive than conventional. So not to confuse anybody, but a good lender will give you sort of the break point on what's better for you on a monthly payment, okay? We do allow, FHA does allow for much lower credit scores, sometimes all the way down to 550 or 520 or 580. But believe me, you don't want to live there from a credit perspective, and we're going to talk about that as well. But the main regulatory bodies, Fannie, Freddie, FHA, there's some nuances, there's some difference. There is a time where FHA makes a lot of sense, especially when buying multifamily properties, 3 and 4 unit properties, and all three are owned by the government. FHA just happens to insure the loans. A good lender will help you with the differences between the two payments.